All right, let's talk about something that's sitting in every business but is so often overlooked, your inventory. We're going to demystify it today because honestly, if you get this right, you unlock the real story of your success. Let's dive in.
So you look at your bank account, right? Cash is flowing in, orders are flying out the door, things seem great. But let me ask you something, and be honest. Is your business really making money? I mean, do you know for sure? Because the answer, well, it's probably not where you're looking.
Yep, it's hiding in plain sight. The real key to knowing your financial health, your true profitability, isn't just in your sales reports. It's sitting right there on your shelves, in your stockroom, in that warehouse.
Okay, so here's our game plan. We're going to break it all down. First, why this stuff even matters. Then, what actually counts as stock. We'll look at how to track it, get into the super important valuation game, and then tie it all together to see what story your business is really telling.
All right, section 1. Why should you care about a bunch of boxes in a room? Well, because that inventory isn't just stuff. It's probably the single most important number you need to figure out your actual, real-deal profit.
Okay, to get to profit, we have to start with something called COGS, or cost of goods sold. Think of it this way. It's the direct cost of only the things you sold. We're not talking rent, we're not talking marketing. This is purely what it costs you to buy or make the products that walked out the door.
So how do you find that magic number? It's actually a pretty simple formula. You start with what you had, that's your opening inventory. You add in everything new you bought, and then, and this is the most important part, you subtract what you still have left at the end. Whatever's left over from that calculation, boom, that's your cost of goods sold. You see why that closing inventory number is so huge? If you get that number wrong, your COGS is wrong. If your COGS is wrong, your profit is wrong. It creates this whole domino effect. It messes up your balance sheet, and it even changes how banks or investors look at your business's health. It's the linchpin holding your whole financial picture together.
Okay, so if that closing inventory number is that important, we better be darn sure what we're actually supposed to be counting, right? So what exactly is inventory? It's probably a little broader than you think. Let's make this real with an example. Meet Priya and her t-shirt business.
So the textbook definition is a mouthful. Assets held for sale, in the process of production, all that. But let's just put it in plain English. It's not just the finished product ready to sell. It's literally everything that goes into making and selling that product from start to finish.
Just look at Priya's shop. Her inventory has all these different stages. You've got the blank t-shirts and the ink. Those are her raw materials. Then you have the shirts that are literally on the printing press. That's work in progress. The t-shirts that are all printed and ready to go, finished goods. And get this, even the shipping boxes and labels count as supplies. You got to track the entire chain. All right, so we know what to count. The next big question is, how do you count it? And this is a big deal because you've basically got two main ways to go, and the path you choose really shapes how you manage your business every single day. Think of it like this. On one hand, you have the periodic system. It's like taking a snapshot in time. Once a month or once a year, you shut everything down and physically count every single item. It's simple, sure, but in between those counts, you're kind of flying blind. Then you have the perpetual system. This is more like a live video feed. Every time you make a sale or receive a shipment, the system updates automatically. It's definitely more work to set up, but you get a real-time view and total control.
And that brings us to, honestly, the most important part of this whole thing, the valuation game. Okay, you've counted all your stuff, but what is it all actually worth? This is where it gets fascinating, because depending on the method you pick, you can end up with a completely different profit number. No joke.
But before we dive into the methods, there's one golden rule you have to know. It's called lower of cost or net realizable value. It sounds complicated, but it's simple. You value your inventory at what you paid for it or what you could sell it for today, whichever one of those is less. It's a safety rule, really. It stops you from saying your old, dusty products are worth a fortune when they're not.
Okay, so for figuring out that cost part, there are a few ways to do it. We're going to focus on the two big ones you'll see everywhere, FIFO and weighted average. Now, you might have heard of LIFO, but for the most part, it's not allowed under international standards, so we're just going to park that one to the side for now. Let's jump back to Priya's t-shirt shop to see this in action. Okay, so in September, she buys 100 blank shirts for $10 each. Easy. But then, a week later, her supplier hikes the price, and she has to buy another 100 shirts, but this time, they're $12 each. So now she's got 200 shirts on her shelf that look identical,
but she paid 2 different prices for them. Now, during that month, she sells 150 t-shirts. So here's the puzzle, right? To calculate her profit, what was the cost of those 150 shirts she sold? Was it the $10 ones, the $12 ones, some kind of mix? The answer depends entirely on which accounting method she uses.
Let's put these two methods head to head. First up is FIFO, which stands for first in, first out. This method assumes she sold her oldest shirts first. So that's all 100 of the $10 shirts plus 50 of the more expensive $12 shirts. You do the math and her COGS is $1,600. Now let's try the weighted average method. Here you just blend the cost together. All 200 shirts cost a total of $2,200, so the average cost is $11 per shirt. She sold 150 shirts, so her COGS is $1,650. Look at that. Same business, same sales, but a $50 difference in cost just based on the method.
And this chart right here is the punchline. You can see it clear as day. Because FIFO used the cheaper, older costs first, her cost of goods sold was lower, which means her reported profit is higher. The weighted average method kind of smooths things out, giving her a slightly lower profit. This is that aha moment. The accounting choice you make on paper directly changes the profit you report.
So what does this all mean? The crucial point is this. The method you choose changes your financial story. It's not about which one is better or right. The real golden rule is that whichever one you pick, you have to stick with it. Consistency is absolutely everything.
Okay, let's tie this all together. We've talked about what inventory is, how to track it, and how to value it. So what's the bottom line for you as a business owner?
Here's what you really need to remember. Number 1, pick a method and be consistent. You can't just flip-flop around. That'll confuse everyone. Number 2, understand the narrative your numbers are creating. Know what your chosen method says about your costs and profit. 3, use this good, accurate data to make smarter decisions, like when to reorder stock or when it's time for a sale. And finally, and this is a big one, the goal isn't to gain the system for the best profit. It's about choosing the method that gives the most accurate and honest picture of your business. That's it.
So I want to leave you with this one question. Go look at your shelves, your warehouse, whatever you've got, and ask yourself, what story is my inventory telling? Because that story, that's the real story of your business.